All right, welcome back, everyone. I'm so glad you're joining me for this detailed explainer on corporation tax. Today, we're specifically looking at the further aspects covered in Chapter 10 of your syllabus for the 2025 BPT exams. Now, I want you to grab your notebooks and get comfortable because we're going to take this nice and slow. We have a lot of really complex rules to cover today, and my goal is to break them down methodically so they make absolute perfect sense when you're sitting in that exam hall. Okay, let's dive right in. So here's our roadmap for today's session. First, the two different tax regimes for intangible fixed assets. Second, the heavy restrictions surrounding goodwill. Third, the specific rules for IFA rollover relief. Fourth, we'll tackle those very important MCINO TOT rules regarding tax losses. And finally, we'll look at actual strategies for loss reliefs. We're going to build this foundation step by step. Okay, let's jump straight into Section 1, the two regimes for intangibles. Now, the absolute most crucial thing to grasp right out of the gate is that the exact date an intangible asset was created or acquired dictates its entire tax treatment. It literally splits the tax world into two completely separate regimes. I want you to write down and highlight this cutoff date, the 1st of April 2002. If an asset is an old IFA, meaning it was created or acquired before the state, it's locked into capital gains tax principles. What does that mean for you? It means there is absolutely no tax relief for amortization during ownership, and any disposal results in a standard chargeable gain or loss. In stark contrast, new IFAs, from the 1st of April 2002 onwards, just follow statutory accounting rules. So the amortization you see in the accounts is generally allowable as a deduction, and the credits and debits flow straight through the trading profits. But wait, there's a bit of a twist for those new AFAs. While they generally follow that accounts basis we just talked about, companies actually have an alternative. They can formally elect to take a fixed-rate deduction of 6.5% per year on the cost of the asset, and they can do this regardless of what amortization is actually showing up in their accounts. This is a massive strategic tool to keep in your back pocket for your exam planning scenarios. Moving right along to Section 2, Goodwill Restrictions and Exceptions. Listen, I literally cannot stress this enough. This is a heavily tested area, and it is just full of strict rules. The general baseline rule you need to internalize is that there is usually no deduction available for goodwill, period. There are two specific dates you absolutely must memorize where relief is strictly blocked. First, if goodwill was created on incorporation after the 3rd of December 2014. Second, if goodwill was purchased from a related party on or after the 8th of July 2015. If your exam scenario hits either of those dates in those specific contexts, alarm bells should ring. Just write it down. Absolutely no tax deduction for that goodwill. Now, what's really interesting about this slide is the exception to that harsh rule. If a company purchases goodwill from an unrelated, arm's-length party on or after the 1st of April 2019, the door to relief actually opens back up. In this very specific case, the company is allowed that fixed-rate deduction of 6.5%. But, and this is a massive but for your exam calculations, that deduction is capped. So how exactly does that cap work? Well, it mathematically ties the goodwill relief directly to genuine intellectual property. To calculate the cap, you take 6.5% and you multiply it by 6 times the cost of qualifying IP that was purchased alongside the goodwill. You also need to know what qualifying IP actually is. It means patents, copyrights, and registered designs. If there's no qualifying IP bought with the goodwill, the cap is 0. No IP, no relief. It's really that simple. Okay, one final, absolutely vital point on goodwill before we move on. If a company disposes of goodwill on or after the 8th of July 2015 and makes a loss, that loss is specifically treated as a non-trading debit. I'll say that again, it is not a trading loss. This means it can be set against total profits, it can be group relieved, or it can be carried forward. But you must make sure you categorize it correctly as a non-trading IFO loss. All right, let's take a quick breath. Section 3, IFA rollover relief rules. We're stepping up the complexity a bit here by looking at how IFA rollover relief is fundamentally different from your general capital gains tax rollover relief. In normal CGT, you know you can often roll over the entire gain, right? But under the IFA rules, the gain you're allowed to defer is strictly limited to the sale proceeds minus the original cost of the IFA. Please highlight this difference in your notes, guys. Examiners love to test this exact limitation. The rules get even more specific if a company rolls a gain over by acquiring a new subsidiary instead of just buying a direct asset. Let's walk through these steps together. Step 1, the company sells the original IFA. Step 2, they reinvest those proceeds into buying the shares of a new subsidiary.
and that subsidiary already holds its own IFAs. Step 3, the calculation. The rollover relief here is limited to the lower of the cost of those shares or the tax written down value of the IFAs held within that new subsidiary. Always look for the lower of in this scenario.
Now, what about moving IFAs around within a group? These intragroup transfers happen on a tax-neutral basis, right at the tax written-down value. The recipient just smoothly continues the amortization schedule. However, you really need to watch out for companies leaving the group. Historically, this triggered a massive degrouping charge. But for any departures after the 7th of November 2018, there is no IFA degrouping charge as long as the substantial shareholding exemption, or SSE, applies to the shares being sold. Okay, zooming out a bit for Section 4, MCNOCOT and tax losses. You are going to see this acronym everywhere in your studies, MCINCOT. It stands for Major Change in the Nature or Conduct of Trade. The entire purpose of this rule is anti-avoidance. Think about it. The taxman doesn't want highly profitable companies just buying up failing loss-making businesses purely to harvest their tax losses and offset them against their own profits. So if a change in ownership is accompanied by a minus Scot, those pre-change losses cannot be used against post-change profits. It completely shuts that strategy down.
I really want you to visually map out these exact time limits in your mind right now, because they differ significantly depending on the type of loss. For trading losses, we look at a strict 5-year window. The change in ownership cannot happen more than 3 years before the MCI knock-cut. But for other losses, there is a much wider 8-year window to watch out for, and that window starts 3 years before the change in ownership.
So when we say other losses falling under that strict 8-year umbrella, what do we actually mean? Well, we're talking about non-trading loan relationship losses, property business losses, and, tying it right back to our earlier module, non-trading IFA losses. If a company is bought out and changes its business model within that 8-year time frame, those specific accumulated losses are trapped. They are completely restricted.
And finally, Section 5, Strategies for Loss Reliefs.
This right here is where you prove you're not just a memorization machine, but an actual tax advisor. Choosing which loss relief to apply and in what exact order is the ultimate strategic puzzle for your exams. A company has to weigh multiple competing objectives. Do they want to save tax at the highest 25% marginal rate? Or maybe they need to claim relief earliest to improve immediate cash flow. Perhaps they want to use group relief specifically to drop their augmented profits below the threshold just to avoid those pesky quarterly installment payments. Or they might need to carefully restrict their loss claims so they don't accidentally wipe out the profits they need to absorb qualifying charitable donations. It's a balancing act. Listen closely, because this is a massive trap that catches so many students out. If your client has overseas income that's already suffered foreign tax, they're entitled to double taxation relief, or DTR. But DTR only offsets UK corporation tax. So if you aggressively use loss reliefs to completely wipe out the company's UK total taxable profits, the UK tax bill becomes zero. And if the UK tax bill is zero, that valuable DTR foreign tax credit, poof, it's completely wasted. It just disappears. So I'm going to leave you with this to ponder as you continue your exam prep. When you're dealing with overseas income, could electing for expense relief, deducting the foreign tax as an expense rather than claiming full loss relief against total profits, could that be the secret to saving your clients double taxation relief? Think about the real-world strategic implications of these choices. You have all the rules now, but applying them intelligently is what will truly get you those top marks. Thanks for studying with me today. Take your time reviewing these concepts, and best of luck conquering Chapter 10.